Hello, greetings, salutations. Welcome to this next episode of Down the Middle. This is the last we're going to be filming here in our Austin series, but we will come back in 6 months and film once again here because I can't get enough of the view of my alma mater, which I think I've said a few times now. But I have the great pleasure of being in the company this morning of Tim Barrett. He's the CIO, the Chief Investment Officer of Texas Tech University's Endowment, and yet we're not filming in Lubbock. Welcome.
Thank you.
Why are we not filming in Lubbock?
Well, we could have filmed in Lubbock, but the investment office was moved here about the time I joined Texas Tech.
Okay.
And they moved it here for a reason. Austin is flourishing with money. So you think Utemco, TRS, ERS,
Right.
The number of managers that flow through here is astounding. So part of the idea was just to be in the flow with other institutional investors and asset managers.
Well, that makes sense. Plus you get to live in Austin.
Plus you get to live in Austin, there's a little bit of a bonus.
No offense, not in Lubbock, but okay, I'm not a big tech fan either. Anyways, that's different. We don't have, I'm just mean football.
Okay, all right.
And I have no bragging rights about football right now at all. So I just bought a second little itty bitty teeny weeny cottage in Culver, Indiana.
Nice.
We call it the Barbie house. It's so small, but my third and fourth child are about to go to Culver in their third generation, and so you grew up in some cold country.
I did, yes.
It's cold up there.
Yeah, I grew up in central Illinois, so kind of in the middle of the state near Springfield. I grew up kind of in a farming community, really. I mean, a very small town. Our whole town had, at the peak, 5,000 people.
Oh.
A major metropolis. And both sides, the grandparents were farmers. My dad owned an irrigation company. So I kind of grew up working in fields.
Well, that'll
Kinda
give
taught
you,
labor
that'll
early.
instill a Midwest work ethic.
I think it did that, and it also makes you really want to go to college.
Oh yeah. Yeah.
You should do that work for a while, and you're like, hey,
Yes.
I think we can do better.
My oldest I suggested Purdue, and he said, I'm out of here.
Right.
I'm so out of here. I'm not going to college in the cold. So I see
don't
where you're
blame
coming
you.
from. But growing up, you were a basketball player growing up, even though you preferred football.
I was a better football player, so I rode the bench a lot in basketball, but probably the funniest story I got on the basketball side was when the coach would put me in, and this will give you a perfect example of my skill set in basketball. He's like, listen, Tim, rebound, pass the ball, play good defense, that's what you're good at. Whatever you do not shoot it.
Don't shoot the ball.
So my job was kind of more the enforcer guy in there and make sure the guys that actually had skill and could shoot and make it had the ball. And I remember this one time, I couldn't help myself. I was wide open on the baseline and I was going to launch it. And man, did I launch it. That thing was an air ball, probably a foot over the rim. Within 2 seconds, it was timeout. I was riding the pine again because I didn't learn my lesson that day.
And you were the Ducks, which is a very intimidating mascot.
Super intimidating. We're the Mad Ducks, we called ourselves.
I mean, Longhorns, Ducks.
Or a duck. They're going to quack you to death. Yeah, it was pretty funny.
So you left for college. Where'd you go?
I went to University of Montana. My older brother was living in Montana, and I loved it out there, so I went there.
So you stayed in the cold.
I did stay in the cold, and then after I finished that run, I went to warmth. So then I went to San Diego State for graduate school.
Okay.
So I decided, you know what, I've had enough of the mountains and the freezing. I'm going to go to the beach.
Yeah. And how was that?
Fabulous. After a few years in Montana, the San Diego lifestyle's pretty good. So yeah, I loved it. And that's actually where I first kind of fell in love with investing. I didn't really know what I wanted to do out of undergrad, but when I got to graduate school, I was in an investment club where we managed a portfolio.
Yeah,
and
sure.
Professors kind of oversee it and kind of guide you.
Sure. UT has the same kind of...
Yeah, so me and some buddies, we were running it, and every weekend we'd work on neural nets and stuff like that on the weekend, trying to develop better stock picking skills.
Yeah.
And just kind of fell in love with the whole process in the markets.
So walk us through how you got from San Diego to Texas Tech.
That's a little longer story, but
That's okay.
the San Diego, when I was doing that, I started looking for work in the industry. It was very difficult to walk right into a money manager. And one of the friends I went to at grad school ended up getting a job at San Bernardino County Retirement Association, which it's kind of east of Los Angeles, kind of in between Los Angeles and Palm Springs on the 10 freeway. So it was not a super large pension fund like Los Angeles or CalPERS or anything, but I think at the time it was like $3 billion, which at the time was substantial.
Sure.
We're talking 96 right now. So he kept reaching out to me.
You started in 96.
Yeah.
And I started, okay, we both got our MBAs in 96.
Yeah.
Okay, cool.
And then he kept calling me saying, you got to come here, look at this pension system. And I wasn't real sure because I kind of really wanted to be on the asset management side, but I wasn't having much luck. So eventually I decided to go work there, and I kind of came in as a project manager, doing some tech stuff, and then also the other half time working on investments. And within 3 years I was the CIO there, because he moved on, and they did a national search, and I ended up winning it. So I stayed there for almost 15 years.
Wow.
After I was CIO, I think 3 years later I became the executive director and CIO, which by the way is a huge win. Because usually you got to ask the CEO about the investment strategy, talk to him, then you go to the board. So you kind of got to get an internal blessing.
Right.
Well, once you become the CEO and CIO, you ask yourself whether you want to take it. So
That's
now
so cool.
now the portfolio strategy changes based on what you think it should change. You just have to ask yourself and then go to the board and convince them.
So
it was a big win.
You were in asset management.
I was at that stage, right? Now I could really decide portfolio structure, and as long as I could sell it to the board, I could implement it.
Yeah, that's so cool. And something called you, at some point, Texas beckoned.
All right. There was an interim step there. So after almost 15 years there, I decided to go to the corporate side. So I went to Kodak, and I went back to the cold, as you might say.
Oh.
So think of Rochester, New York.
Kodak.
In
Okay,
fact,
for you younger viewers, Google Kodak with a K.
Yeah.
Okay? Google it.
There's a Paul Simon song for you called Kodachrome. There you
Yeah.
go. But I went there mainly for the experience, because it was $16 billion system. They really had no staff. They ran Portable Alpha, which we can talk about later, but
Sure.
I also ran that at San Bernardino, which made me a good fit there. But they had 77 plans around the world. And
Wow.
the idea that I could run European plans, Asian plans, everything, and have my hands globally and get experience with different boards around the world was really intriguing to me.
That's so cool.
And
So then you went and saw the world.
so I went and saw the world and realized I'm never home, which was hard with little kids. And I did that for about 3 years through the Kodak bankruptcy.
Wow.
Which is a completely another story about what we did in Europe during the bankruptcy.
There is no PBGC. There's no Pension Benefit Guaranty Corporation in Europe.
There isn't. And we actually, I think we're the only people in history to, during bankruptcy, sell off companies to the pension system and have the pension system there forgive any liabilities to the mothership in the United States, and then reattach to those companies we sold them. And we got regulator approval for all of that.
Wow.
And we did all of that within about a 2-year span.
That's like a massive unwind that you...
It's a massive unwind, and it released all the liabilities of that pension system back to Kodak in the US.
Which could subsequently be written off.
Could be written off, correct. So that was a massive undertaking, a lot of work. It's also fascinating. You get to work with a lot of really smart regulators, as well as advisors in Europe to get that done.
It reminds me of Lehman when it went down. I mean, there were people who made entire careers out of unwinding Lehman.
Oh, absolutely, absolutely. So after that was about 3 years, and then that's when Texas Tech came calling. So one of my friends mentioned to me that they were looking for a CIO, and honestly, my first jest was, I'm not going to Lubbock. Well, my first question was, where's Texas Tech located? And then the second one was, I don't think I can go to Lubbock. I don't think my wife would let me go there.
Wait, remind me of what the mantra is with the football games?
Oh, guns up.
Get your guns up.
Guns up.
Get your guns up. Right,
Yeah.
okay. As opposed to hook 'em. All right.
So anyway, I ended up interviewing and taking that job, and they at the time had already decided that they're either going to relocate to Dallas or Austin.
Sure.
And of course, I think I had some influence on that, and they said, oh, I think Austin's the right spot.
Yeah.
And the rest is history. We've been here. I've been here almost 8 years now as CIO at Texas Tech, and it's been a great run.
So, talk about how pensions differ. I mean, a lot of pensions are obviously at their most funded. Public pensions, defined benefits, are at their most liquid funded stage that they've been at in like a generation, just by virtue of the fact that they're exposed to the public stock market alone. But talk about how pensions differ in terms of their governance, in terms of asset allocation, who has influence. Because when you think about a teacher's retirement system in any state, for example, you're going to have like a great person who's a third grade teacher on your board.
Right.
And they might not be able to sit down and have a full discussion with you about alpha and beta and gamma.
I can almost guarantee you can't have that discussion. But there's massive differences, in my opinion, as you work through pension to corporate to kind of endowment and foundation. From a governance standpoint,
and I think people put them all together.
They do, and I can understand the desire to want to put them together, because in the end, yes, they're different from a governance standpoint, they're different from a talent standpoint and a pay standpoint, which I can get into. But in the end, they're all trying to do the same thing, and that's why people lump them together. Because if you're not in the business itself, then they all look the same, right? They're all trying to get 8 to 10% return, and they're trying to do that as consistent as possible.
Yeah.
But they're going about it completely different. Right?
Yeah.
So
I mean, when you look at allocations to alternatives in some of the most underfunded pensions, you'll find that their allocation to alternatives is substantially larger than that of more conservatively run pensions that are more funded.
Yeah, I think that's absolutely true. So if you look at like San Bernardino, I think is a perfect example, and there's 20 systems in California that run under what's called the 1937 Act. And they're all county retirement systems, including Los Angeles County, which is the largest system of all of them. And they're very similar to all public systems in that they get elected members and appointed members. So the Board of Supervisors in this case would appoint like half the members. The other half are elected by the membership itself, like whether that is the Sheriff's Association, the firefighters, or the general employees.
Gotcha.
None of those elected people have any skill set whatsoever in investments, like zero.
But it's a half and half.
Even the appointed ones, when you're talking about being from these certain counties, like if you were in Los Angeles, you might be able to find investment people. When you're out in San Bernardino, you might get an accountant on there, you might get a business owner on there. They're not investment professionals by any stretch of the imagination. So it's what you end up with is a group of really novice people who are trying to guide the ship. And they're trying to guide in really unfamiliar territory, right?
Which is why they can be guided.
That's why they can be guided. So the really critical point is having a strong leader and a strong investment person at the helm to do that. I think the second piece you see at public funds is just widespread use of consultants, right? Since they don't really understand what they do, they want that second opinion from the consultant, which is a good decision. But it's only a good decision if you have somebody strong at the helm that's actually making the decisions, and the consultants kind of verifying that, yeah, this is good direction.
Right.
I think once you get to the other side of the equation where you let consultants drive the whole portfolio, I think it gets messy really quick.
So I'll tell you a funny story. In 2004, I think, I was out in Omaha. I got to go meet Warren Buffett, but I really spent time with Charlie Munger. And he made this comment that one day when central bankers were less influential in the markets, that the entire pension consulting industry would go the way of the dodo bird. It would just disappear. And I'm looking at him, and he's 80 something at the time, and I was like, that's really deep. And he's like, yeah, the whole efficient frontier will go away. And I was actually speaking with somebody who studied under Gene Fama, and Gene Fama's changed his mind on his own efficient frontier.
Right.
And he's a Nobel Prize winner, but he's like, no, it doesn't work anymore.
It doesn't work.
It's fascinating.
Yeah.
But the consultant industry is based on that.
It is based on that, but I think, if you really dig down to the heart and essence of it and think about why does a board want that? It honestly goes back to CYA, right? They want somebody to lean on. They want somebody to say, hey, I know we lost $100 billion in the sell-off, but the consultant thought this was the most prudent asset allocation, and we're sticking to our guns, and that's the mantra, right? And people live by that. So I think that paints a good picture of the public funds, and there's always exceptions, right? There's, Texas Teachers is a great exception. I think if you look at them, that's an extremely well-run public fund.
Yes.
So they run the gamut where you'll find really well-run ones and poor ones just like anything. Then switch to corporate. Corporate to me, and granted, I've only worked for one corporate, so I'm generalizing here, but
sure.
The board at Kodak, the way it was made up for the investment committee, was the treasurer himself, who I worked right next door to and reported to. And then the CFO was on the board, head of HR, etc. So there was a handful. They were all working people in the corporation with the corporation's best interest at mind. But they were busy all day, so they didn't have all day to sit around and pick through your portfolio and ask you what you were doing, nor did they want to.
Right.
In there, it is you deliver against the liability curve or you get fired. And it's very straightforward.
Pretty simple.
So, that was literally the thing the treasurer said to me day one. Like, if you lose money against this liability curve, we're going to fire you. And I looked at the portfolio and I'm like, we're going to make a lot of changes really fast, right? Because they were not hedging their liabilities all the way, right? So I was taking a huge liability mismatch. And I was like, the very first thing we're going to do, because you're really well funded, is we're tightening up the liability curve dramatically. And we're going to start taking some beta off the table and be a more absolute return against that benchmark. You can say that was a really smart way to run a portfolio. It's really about self-preservation here. I definitely need to make those changes to make it work. But I think the biggest difference is the governance, right? So when you roll through to that group, I would tell them what I was doing with the portfolio, and I would take my manager selections or my asset allocation changes to them. And they would read through the memo real quick, and it was quick. Those meetings were like an hour and a half long. I might have 6 major changes. And they'd go through them, and they'd say the treasurer's job was to really look at it. And they'd kind of glance over him and say, did you go through all this, Bill? And they'll go, yeah, it looks good to me. And they'd go, oh yeah, it looks good, go.
Yeah, because all Bill knew was that he was going to fire you if you...
Right.
It was pretty simple
it's
for
all
him.
on Tim's head anyway,
yeah.
Right? But you could move way quicker, and you also don't have the time when you have 77 plans globally to sit around and discuss it. You have to grant authority to your investment team and let them do their job.
So I'm curious, because we've seen so many pensions disappear in corporate pensions disappear in recent years, and they've kind of sloughed them off to insurance companies. And are you allowed to do that in other countries?
Not as easily. It depends on each country's different.
Okay.
But I'll pick Europe because that's the easiest one everybody knows about. Really hard to do in Europe.
I would figure.
Like if you go try to shut down a pension plan in France, which by the way we tried, the amount of checks you got to write almost makes it not worth trying to shut down. Because you got to pay for the employees if you're going to, especially if you're laying them off, you got to pay for them for a long time.
Oh, yeah.
Then you got to pay off that liability. You're almost better just trying to keep the company going, and finding a buyer for the company is a better exit strategy.
Wow.
It's very, very difficult.
Because if you think about the companies that still have defined benefit plans, and you can practically name them at this point.
Yeah.
But they're international operations like Ford or General Motors or Caterpillar or General Steel or.
I think it puts them in a competitive disadvantage if you think about the new and upcoming companies. Because the new and upcoming companies won't give those benefits.
No.
They know the rules now. So they're always going to put 401ks or the equivalent of a European 401k into place to not have that liability burden.
Yeah, of course. They've learned. So let's
But just one last thing on,
sure.
on the, when you think about the corporate side, we kind of talked about that. And then endowment side,
right.
I think the biggest difference in endowment and foundations, even more so than corporate, and definitely more so than
you're
public.
bucketing endowments and foundations together.
I kind of bucket them together. Okay. It's really skill set. So when you look at the boards that typically, the board members that sit on an endowment or foundation, a lot of times they're guys that worked at a hedge fund, or they're a private equity guy or a real estate guy. They're guys in the business that are on those boards. Mm-hmm. Now, depending where your foundation or endowment is, you may not have 100% of that, but you're going to have a number of people on that board that understand your language, understand what you're doing, understand market cycles, mm-hmm. And honestly, in many ways makes it easier for the CIO to get things done.
Well, sure. They literally speak your same language.
And it changes your support metric for when things go bad. So like markets always ebb and flow, and you're going to have tough years as a CIO no matter what. If you have a board of professionals that actually understand that as well and work in the industry, mm-hmm. they understand that when it goes down, it's likely time to step on the gas, not get scared.
Right.
And if you have the other board, the public fund, when things go down, they retrench and lock everything down.
Yeah.
So when you're supposed to step on the gas, they never do.
And that's why so many of them have never come back.
That's right. That's right.
Fascinating. So how should, ideally, in your mind, how should any defined benefit plan be allocated in this world that we live in today? By the way, the thought crossed my mind that Jay Powell could be he could sit on a foundation board. If in 4 years, if he leaves the Fed, he could theoretically, that would be a great job for him.
Yeah, something tells me that he won't, but it would be a great job. How to allocate in this environment is a great question. I would say, now is time to curb your enthusiasm. I think it's the best way I would say it for everybody.
Well, don't tell that to a Dogecoin owner.
Oh, right, yeah, well,
don't tell
exactly.
Well, whoever just bought the NFT for $450,000 for Snoop Dogg's virtual party house.
That is definitely going to be worth like $5 million later.
Okay, I'm going to hold you to that.
Yeah, I don't really understand that part of the market. I've heard about some of those things. I heard another one where a guy bought an architectural drawing of a house on Mars, of course all made up, and paid millions of dollars for it in an NFT. I'm like, what are you going to do with that? I mean, it's the ultimate sucker trade, right? Like you buy that and you're hoping the ultimate sucker is there to buy it from you later.
But it's also emblematic of, from the biggest perspective all the way out to Mars, it's also emblematic of how much liquidity is sloshing around in the system. Yeah. And the last time we had this much liquidity sloshing around in the system was 2017.
Yeah, I think it goes right back to your question on how to allocate now, right? So if you think about where are valuations right now, right? Through the roof, right? Especially if you look at US stocks, even more so than European stocks. You look at credit spreads. They're tight. You couldn't get much tighter. And that's investment
junk is
grade.
Negative yielding. And I'm like, trying to explain that to a layperson. Yes, for a high yield bond has got an inflation adjusted negative yield. And they're like, what?
Right. It makes you say, yeah, gold and cash looks pretty good right now when you think about that way. But the problem is that pension funds, endowments, all of us, you can't do that.
Right.
You have to stay invested. Mm-hmm. So now the question is, how do you adjust your allocation? Well, if you have an equity allocation that's 60% like a lot of people, you got to push it down to the lower end of the range, mm-hmm. right? You got to build your cash position or your negative convexity trades, right? Your convex trades. So we have a couple managers that are high convex fixed income long short guys, mm-hmm. And we're building much bigger positions than them. We're getting get ready to add another manager in that space, and we already have one, and we're going to severely overweight those guys, pushing more capital into them.
So you're increasing your hedge.
I'm increasing my risk offset. Yes, hedge. I wouldn't call it a pure hedge because, they generally in a normal market will make you 5 to 7 kind of % return, which is nothing special, but it's okay. The fact that it's positive is a home run.
Yeah.
And then, like one of our managers in Q1 was up 44%. So that convexity pays off when there's a major dislocation.
Right.
So I think you need to find some of that. You need to get some trend offset into your portfolio.
Q1 of this year.
What's that?
Q1 of 2021.
Of 20.
Of 20. Okay, okay, that makes more sense. Q1 of so when the pandemic hit.
When the pandemic hit.
I mean, people have clearly forgotten very quickly that we had multiple circuit breakers go on a daily basis. That,
right.
Like throughout the trading break, you were hitting these circuit breakers. It was just.
Yeah, if you're in the business, you were nauseous that entire day watching it happen.
Yeah.
It was the fastest in history, in my opinion. You can go back to 2008, and you had time to adjust. There really wasn't any time to adjust unless you're trading derivatives. You had no time to.
Well, no,
even
actually,
trading derivatives was hard.
It actually was the fastest in history.
Yeah.
Prior to that, it was 1933.
Correct.
So 2020 was the fastest.
33, I don't recall, but I've seen it on paper.
Well, yes, and actually 34 was not pretty.
Right.
At all. In the markets, it's just the market came way back in 34, and then it just went into a long-term slump.
Yeah, and I think you're seeing a little bit of that same kind of formation now, right? So you think about Q1, everything tanked. Now we're rallying off of just pumped up liquidity, Fed helping the markets like there's no tomorrow, paying money directly to consumers, and they're spending. All of this is just pushing asset prices, right?
Yeah.
You go out to bet on an asset now, there's so many people betting on every asset. And that whole idea that I get a proprietary deal, that doesn't even exist.
Oh, sure.
And
you've got the people with the most money, with the most dry powder, who are bemoaning the fact that there's nothing to buy, and yet the deals are still getting done. It's just the multiples are going through the roof.
Yeah, it makes an investment job and trying to run a portfolio very difficult right now. My advice to everybody would be is get as conservative as you can get within your policy.
Mm-hmm.
I think a perfect example of what we're looking at right now is like we use derivatives to run portable alpha,
mm-hmm.
which just means that we get our beta through a derivative like an equity swap, and then we invest in hedge funds and hold cash. The hedge funds we turned into swaps, and then now that way you have way more cash behind the portable alpha construct. So the idea is that you can handle a much larger drawdown than what, say, a traditional portable alpha structure would allow.
Mm-hmm.
In our case, we can handle about a 50% drawdown.
Wow. With
a 0.5 correlation between the hedge funds and the beta, which by the way is unheard of. Like these large multi-strat hedge funds rarely if ever go to a 0.5 correlation.
Wow.
They usually run at closer about 0.2 to 3. So we're really
presumably there
that.
aren't very many of these amazing hedge funds out there.
There's not. We typically stick with huge multi-strats for the portable alpha construct.
Mm-hmm.
As you know, I would say that there's 12 globally that I think are, best of breed.
And you used to be able to be a very focused hedge fund, but I mean, people forget the idea of correlation.
They absolutely do.
They forget, we're sitting here in Artemis Capital's offices. I mean, Christopher Cole was the first person to show me that over the past 100 years, which he looks at often, that real estate is a very pro-cyclical asset class.
Absolutely. Yeah. So is private equity, by the way. Everybody thinks that's a diversifier. It's not a diversifier.
No.
It is cyclical just like equities.
It's more cyclical than equities because there's no exit.
Absolutely.
At all. And
Absolutely.
they're illiquid.
Yeah. And we're like everybody else. We have private equity as well, and it's
mm-hmm.
done extremely well this last year.
Mm-hmm.
But I would say still you got to go back to fundamentals now, and the fundamentals don't look good. The technicals don't even look good right now. So like if you just look underneath the market about how the market's moving, right?
Right.
A handful of stocks are driving it. And now you're starting to see a lot of interim volatility underneath the surface where you're seeing really good companies down 20, 30%. Mm-hmm. And, that'll last a little while, and then liquidity comes back and people buy those right back up.
Yeah.
So that interim volatility, I think, is a warning sign for people to think about, that the markets are going to keep getting more volatile as we go forward here.
So outside of clearly being protected by some of the best managers in the world and how they operate, which is a handful, which means that there aren't that many people who can gain access, that many investors who can gain access
Right.
and be hedged. That's why as individuals right now, there's no shame in cash, and people don't.
There's no shame in cash.
I mean, I've got a huggy bear relationship with my municipal bond portfolio,
Yep.
because I think that any legislation that's eventually passed is going to benefit states and municipalities.
Absolutely agree.
So I mean,
It's a great place to park your money when
Yeah.
you don't like the equity market.
Yeah, but speak to speak to private equity, and then
Mhm.
speak to passive investing, because again, if you look at the poster child, if you look at the city of Chicago, their allocation to alternatives is, I want to say 39 or 40%, and they're underfunded, I think, by about 60%.
Mm-hmm.
But again, this is probably the worst. There's a competition between the state of Illinois and the city of Chicago to get to the worst funded pensions in the country. Kentucky's up there somewhere.
Is that due to performance or funding issues? Because I know in Illinois
Both.
they have issues of not funding their pensions.
Both.
And that's the fastest way to ruin a pension fund, is not send your money in. But I will talk about private equity a little bit. Private equity for us, so if you think about our portfolio, we run roughly a 60-40 portfolio.
Mm-hmm.
So roughly 60% is in equities, 40% is public equity, 20% we're going to call broadly private equity.
Okay.
When I say broadly private equity, that's because there's lots of things that are private that are equity oriented, right? So real estate, for instance,
Mm-hmm.
is private equity. Oil and gas stuff, that's private equity in our view.
Yeah.
If it's equity centric and it's private, it's in that portfolio.
Right. Infrastructure. I mean, there's so many different little
Infrastructure's another one,
categories
right?
that are within private debt. I mean, there's so many.
So if you think about like what would I do in private equity if I had fresh money right now?
Mm-hmm.
You probably should really be thinking about infrastructure, farmland, all of this kind of stuff. Why? Because it does well in inflationary environments.
Mm-hmm.
2, it sure appears the government wants to support infrastructure, so you got wind at your back there.
Yep.
And 3, rates are still cheap. So most of that stuff has leverage related to it.
Mm-hmm.
So it should do pretty well in this environment. Where do you maybe struggle going? Like adding more large buyout might be, something you might want to tap down just a little bit.
And they keep raising record level sizes of funds. It's the fundraising just continues unabated, and it's the public pensions that are feeding this beast.
They're definitely feeding the beast, and they do it for multiple reasons. One, if you go back over the last, let's call it 3 decades, right, and look at the alpha generated, we're going to use the term alpha loosely.
Mm-hmm.
In other words, did it outperform your broad equity benchmark? Right? You go back 3 decades ago, private equity crushed it. It wasn't even close compared to the public markets.
No, that was, I mean, I've said this on many interviews. I was at Donaldson, Lufkin and Jenrette, DLJ,
Right.
when private equity wasn't even a thing. I mean, we had this merchant bank, and the returns, Leon Black was walking around, and Tony James and Schwartzman was at deals, but their returns were truly diversifiers. They were off the charts.
Off the charts. Yeah, it was a beautiful time to be in private equity if you were there.
Yeah.
So then you go the next decade, and you can literally see the charts on this alpha just dropping, right? So let's say it was 15% ahead of the market 30 years ago.
Mm-hmm.
20 years ago, it dropped to 7.
Mm-hmm.
You know what it is today?
I don't know that it's even positive.
It's positive still, but it's real tight. It's
Is it positive net of fees?
It's still positive net of fees, but it's like 200, 300 basis points. So now your question is, I'm locking up my money for 10 years. I'm paying somebody a lot of money to run it this way.
Yeah.
I could argue on certain private equity strategies, buyout being one of them, that I could grab a Russell 2 and run it at a 1.4 leverage ratio.
Mm-hmm.
Maybe run it at 1.5, a little higher, and then throw a few hedges on the side and recreate the same return in private equity, but be liquid. Is that because you have to ask yourself, is 2 or 3 percentage points worth the? I mean, does that pay the illiquidity premium? I don't think it does. And in my view, you got to get to about 500 in your portfolio. If you're not delivering 500 over the broad equity markets,
Mm-hmm.
I question whether you're either one, not doing a good job, or two, it's not there anymore and you should be changing strategies.
But they can't go to cash because they keep raising cash.
That's true. And then the other piece of it, I would say, is we've talked about buyout and farmland a little bit and infrastructure. The other piece is growth and venture capital. Mm-hmm. And if you go to like the big pension funds we were talking about earlier, they really don't have access to that. Why? Because those strategies are niche and they don't take a lot of money. Mm-hmm. And somebody like Texas Teachers can't write a check for $400 million into a venture capital manager. They just don't take that much money.
Right.
So the people that play in there are really endowments, foundations, family offices, right?
Sure.
Venture capital has been the hottest thing since sliced bread the past 2 years.
I mean, look around you.
It's amazing, right? Most of our venture capital is up 100 to 300% in the last 12 months.
Gosh.
Right? And we had exits of some of our private equity holdings that are 20 and 30 times money.
And I might or might not have tweeted out about Jay Powell modifying the Main Street lending program to put under the umbrella portfolio companies of private equity firms.
Right.
I might or might not have tweeted out about that in something of a fit of rage.
Yeah, I don't know that that's a good idea. The interesting thing I think about this space, and this goes to the whole market, and this shows how much liquidity is out there, and it shows how overdone the market is, mm-hmm. is all of these private guys typically raise money on a 3-year cycle, like venture capital and stuff, and private buyout guys. They're putting money to work so fast that they're coming back to market in a year and a half. And then the thing with venture capital is you can't just get in, right? It's hard to get into top tier venture capital guys. Mm-hmm. And if you say you're out, you're persona non gratis. You're not coming in next fund.
Yeah.
Or if you shrink your allocation, that's your permanent, that's where you're going to be. They're going to bring a new client in. So you find yourself stuck in this weird juxtaposition where you're like, I know I should not be really upping more money into venture capital.
Yeah.
But they're coming out with a second fund, and if we're not supportive of the firm, we're not going to be with the firm. What do you want to do?
I mean, that's a dilemma.
It is a dilemma. For us so far, we're continuing to do it. I think the advantage we have is we started our venture capital program 5 years ago, so it's still new. Mm-hmm. So if we overweight a little bit, we're okay. Mm-hmm. Somebody that has a program, like a Yale or any other big boy that's been around for decades and been in the venture capital business
Sure.
forever, I would think that they would have an even bigger problem. Just because everybody's asking for the same thing, and are they really going to come back? And then you get into a different liquidity problem because venture capital won't always be hot. It's gone decades where it's anemic and you're not really getting paid to be in it.
Well, I mean, one of my favorite statistics was, this is pre-pandemic, was that as levered up as large companies were, mm-hmm. small and medium enterprises were levered up even by a multiple of 2 times what, we're all worried about the corporate bond market blowing up, and
yep.
Jay Powell comes out and bails out the corporate bond market and
yep.
gets married to the Treasury to do it. But that was not the most levered up little slice of corporate America.
I agree. So, I think the private equity business now is like the public equity business. It's overdone, it's super competitive, so you're seeing the amount of money you make on it go down and down. And by the way, this is true in hedge funds too. So it's true across the board. It's what we call is just declining alpha everywhere. So this really gets back to your question about, when you mentioned Chicago and how much alternatives they had. Mm-hmm. If alpha is declining in private assets, if alpha is declining in your hedge fund strategies, mm-hmm. I mean, the original hedge funds were to beat the equity market. That's why they're named hedge funds. Right.
People forget that they were designed to hedge.
But they're not used as that anymore. Like hardly anybody hires a hedge fund to beat the equity market. They have equity allocation, it's over here, or it's in the private equity or public equities. Mm-hmm. It's not a hedge fund. They're using hedge fund as diversification strategies. Why? Because the alpha's gone down so low that it can't be called anything but that. It is now a bond replacement diversification strategy.
Yeah.
Right? And there is a place for that, I believe, in the portfolio. just because of what's happened to the yield curve.
Mm-hmm.
If you look at where yields are now, like, does it pay to own the bar cap? I'm going to tell you absolutely not, right? That's a big part of pension funds.
Yeah.
So you need to find a liquid or at least pseudo-liquid replacement. Hedge funds fill a great role there. Or you're not getting the alpha that you would in equities, but you're getting enough to beat the bond market, which by the way is negative. So it's not a high hurdle. So that takes me back to your other question about passive, right?
Yes,
So when we think about private equity, you got to be with the best of the best, in my opinion, to get that liquidity premium. When you go up to the public equity markets, everybody seems to be passive. That trend's been going on for a decade. I think you talked on some of your pieces about it.
Gosh, yes. I mean, but I keep telling people, in 2006, the law changed, requiring human resources managers to, it was the opt-in law that was first. So
Yep.
New employees have to be opted into the 401k. If within 30 days of being opted in, they have not designated how they want to allocate their 401k money, what funds they want to put it in, of the limited choices they have, then the HR manager, by the law of the United States, is required to put them into a target date fund.
Yeah.
That happened in 2006.
I think it's a safe harbor choice, right? I think is what they called it.
Yes.
Kodak did the same thing, right? So they had all target date funds, and every time somebody joined, boom, you're in it, right?
Yeah.
And I don't think most people ever look at it again, to be honest, because supposedly it's set up for you. You're right, that drives passive investing, right?
It drives it to an increasing degree because of the demographics, because the average American right now is 39 years old.
Mm-hmm.
So that alone tells you kind of where the target date of the country is,
Yep.
if you will. It's kind of 39-61.
So every 2 weeks, paychecks come out, go in, and drive those markets.
Mm-hmm.
Then the second side of that, I would say, over the last, since I've been in the business in '96, like I remember in '96 when I got to the portfolio, we had passive, but the majority of our equity portfolio was active managers,
yeah.
right? The majority of them, and that was every pension fund was very similar.
Mm-hmm.
Fast forward to today, you got S&P putting out the persistence report, which I'm sure everybody's seen, which shows how many active managers have beaten the index over 1 year periods, over 3 year periods, over 5 year periods, over 10 year periods.
Mm-hmm.
And if you pull that report, and just about anybody can get it,
Yeah.
you see that active managers dramatically underperform over time.
Right.
Well, part of the reason is what you mentioned, right? More and more flow from the passive side through these target date funds and through pension funds pushing more money to passive pushes the exact same stocks up. So if you're an active manager,
there are 5 or 6 of them right now.
Absolutely.
Stocks.
Yeah.
In total that are driving
the market.
the market. People are like, yeah, this is just like the nifty 50s, and I'm like, there's no 50.
Right. 50 was diversified.
Exactly. 50 was like enormous. There's no 50. There's a handful.
Yeah. Absolutely agree. And I think that's going to keep going on for a while, right? Because I don't see target date fund solutions changing. That's a mechanism that's in place.
That's a law change.
And hard to change, right? Yeah. Then you got to switch to, the big institutional buyers. Are they going to change their views? That's like turning the Titanic.
Mm-hmm.
You'll have a few mavericks change their view. Some guys that are really thinking outside the box, they'll change their view. But the vast majority will not, which
Mm-hmm.
means that's going to keep going as those funds grow.
Yeah.
So I don't see.
That's why you could potentially see what you've just described is why people now say NASDAQ is the risk-free asset.
Right.
Which makes your head hurt.
It absolutely does. Yeah, and it's definitely not the risk-free asset.
I know, but it's because of this. I don't think that people have necessarily gone and done the modeling and looked to see what every marginal dollar that goes into passive, how much bigger of a multiplier that is versus $1 active.
Yep.
But it's huge and it's growing.
Yeah. I would say when you're in a bull market like we've been in the last 18 months, ever since Q1 of 20.
Oh, I would argue since 2009.
Well, it's actually been longer. We had the blip of Q1 20, but you could go back then, and it doesn't really matter if you're in passive or active, because the indices just have gone through the roof with all the Fed support. So to me, the real question is when that changes, right? And I think you're already starting to see inklings of this, and I'm sure you've talked about it, right? Is when rates start going up and the yield curve changes, you've already seen just the scare of the rate curve going up hitting software companies and tech companies.
I've never seen the yield curve compress so fast we've both been in the business 25 years. I've never seen the yield curve compress as fast as it is. I've never seen the short end go up as quickly as it is and the long end come down as quickly as it is.
So I think every investor should be asking themselves, what happens when the 10 years at 3 if we go there rapidly? I can tell you what's going to happen. The stock market's going to take a hit like you haven't seen in a long time. Then what happens if we just go ahead and add on liquidity?
I'll push back. I think the Fed's going to tighten into an inverted yield curve.
You think so?
I think that they're going to be faced with that choice.
Yeah.
Because I've never seen I've never seen a curve try and race to an inversion as quickly as it is.
I don't think I would disagree with that, because they're going to have to push front end rates. They're behind the curve.
Right. So I
the
mean, they
front
can
end
be
of the
faced with
curve's
the
gonna
ultimate
go
dilemma.
up, right? So you're almost, but you could get back to a stagflation argument pretty rapidly. Stagflation is not good for stocks.
No.
And you're going to see trouble there, right?
No, I mean, stagflation preceded the lowest price to earnings ratio since 1920. That was 1981. That's
Yep.
The stagflation made stocks really, make stocks cheap again. It would.
It'll make stocks cheap again. I don't disagree with you. I think you could easily see the front end of the curve come up, stocks sell off, and then the outlook be poor because we still have fairly persistent inflation.
Yeah. I mean, I think 2022 is going to be, we were speaking before we were on film. I mean, just the gaming of what used to be called food stamps, and now it's, supplemental nutrition assistance program. I mean, the gaming
That's
of...
a much nicer name now, by the way.
SNAP. Food stamps, SNAP. But there are certain idiosyncratic drivers of inflation that are going to be hard to pull down. Food inflation being one of them, because people are selling their SNAP cards to get cash for 50 cents on the dollar, whatever. We were talking about the ports of Los Angeles and Long Beach, and their contract is up on June 30th. So they'll likely they've gone on strike every single time their contract has been negotiated since 1990. So the likelihood of history tells you that they're going to go on strike.
Yep.
So let's say we start unwinding the mess at the ports, and then they go on strike. So
and the mess is right back again.
You're back with freight costs that are. So there are some. And then I think this is even in the face of inventories building. I think you're going to have an inventory. I think you're going to have a stockpiling problem soon, but it won't matter if freight's still through the roof. To your margins.
I mean, I think companies' natural reaction to this probably would be to stock inventory, right? As soon as they can get it.
Well, there's already evidence.
If they don't trust the system,
right,
you're going to overstock inventory, which is, what is that? A drag on margins again, right? So we're back to the same thing, which is we have an overvalued stock market. Now we have another influence hitting margins. And we're not even talking rates yet, but if the rates move too, and then that third piece to me is like, what are they going to do with the balance sheet? They've been buying assets, pumping liquidity in the market. They're talking about tapering, reducing the amount they're buying. What happens when it starts going really quicker and you're really pulling it out?
And that's what, I mean, the old Jay Powell went away the minute he was renominated. And he started talking tough again, like he was when he first became, chair in 2017. I mean, it was meet the new Jay Powell. He was the same as the old from 2017 before the Powell pivot.
Right.
So if he gets, I mean, it's tradition that the Fed not change policy right before Christmas, and yet
here we go. Yeah, I mean, it brings you back to portfolio positions and how do you think about solving for that problem. And it is a super difficult thing for any CIO, right? Because you've got to stay invested. So there's only a few levers you can pull. You can put some more hedges on, but right now hedging's crazy expensive.
Right.
You can put
we were talking about that.
You can put some counter trend stuff onto the portfolio. And you could put some, swaps and things that trade counter to the market. In other words, momentum-based strategies that will go long and short. That will help you out.
Are you
and you
allowed
can
to
raise
own
cash.
precious metals?
You can own precious metals.
You're allowed, okay.
Any endowment can buy commodity funds and all that kind of thing.
Okay.
And that's not a bad place to go, is to park money in commodities. I would say that if you're going to go commodities, you'd want to go long short with a really competent manager.
Yeah, because right now commodities are trading in different directions.
They
So
are
you have to be
trading
really
different.
careful between, somewhere between iron ore and soybeans. You're like, whoa, you could drive a Mack truck through that. So
Yeah, and my personal view on oil is it's going to go through the roof, just based on policy, right? The policy in the United States, the policy globally is all to see how much lithium we can mine to build batteries for cars.
yeah, I mean,
And to
France
shut down everything.
France is sitting on top of one of the biggest shales on the planet.
Right.
And all of the French banks have made a pact to not provide financing to anybody who wants to frack in France.
Yep. And it's here too. We're pressing hard against our oil and gas people
Yeah.
to not do it. I don't know if you saw recently, there was like 16 states band together and sent a letter to all the banks saying, hey, we're going to create our own bank if you mistreat or treat people poorly there in the oil and gas business. There's a lot of pushback coming from states. They're worried about the economy and jobs. Mm-hmm. And the banks are worried about ESG and the global environment, right? And it's that clash, right?
That's a lot of tension.
That's a lot of tension. And whenever you have a lack of capital in anything, right? When the capital runs away, then the opportunities are massive.
Right.
So I do think that,
I mean, the irony for me is that electric vehicles require, they chew up more environmentally than internal combustion engines, but nobody wants to talk about that.
Yeah, I've seen some studies where a guy, he went through and did a really deep analysis saying, like, what is the break-even rate if you consider, what it costs to mine and what that does to the environment.
Exactly.
And how long do you actually have to drive that electric car, and where's that break-even point? And it was a ridiculous number. It was like 9 years.
Yeah.
And last time I checked, I don't know anybody in my neighborhood that keeps a car for 9 years.
Well, now you've met somebody.
You have?
Yes.
Well,
I have a 19-year-old Land Cruiser.
that is awesome.
Well, they're built to last forever. So
They are. I think almost everybody I know has, they just sit around, do the leases, and go get a new car every 3 years.
Oh, I mean, you see it. You see it everywhere.
Yeah,
I mean, where I live in Dallas, it's the number one McLaren market in the country.
Right.
And it's just, and so let's shift gears.
Okay.
Because I was recently at Highland Park Village, met a girlfriend for lunch. It's kind of the toniest area that you could. It's the Rodeo Drive of Dallas.
Nice.
So it's got Chanel, it's got Gucci, it's got Fendi, it's got Hermes. It has every high-end store that you could possibly ever name. And I happened to be there on a Saturday, meeting a girlfriend for lunch. And there were lines everywhere. Lines. Long lines outside of Chanel. There was a line outside the Rolex store that had no merchandise in the window. No merchandise because I was there on a Saturday, it had opened on a Friday and it sold out within an hour.
That's insane.
The Rolex store. So
So high-end market looks good.
the rich are really rich.
Right.
And they, if you look at it in the broadest sense, the top 10% account for 22.3% of US consumption. But when you get down to certain discretionary type of purchases, and this is all Bureau of Labor Statistics data, when you get down to certain discretionary areas, they're upwards of 45% of consumption in these areas. The rich are really rich. So, I mean, my question to you is, and this is getting to the fundamentals, the risks that you look at outside of just through that prism of the markets.
Right.
So if you're a busboy
Right.
in the restaurant where I had lunch and you see all these lines, you're mad.
Yeah. I can't imagine that you're not. Yeah, I think you're talking a little bit about kind of what the whole part of the cultural problem in the United States and globally is, right? I don't think that's just here. I think we're a great example of having a bifurcation problem. The question is how
for a developed country, we have the biggest.
We have the biggest.
For a developed country.
But I'm not exactly sure how that gets fixed, because that has to get fixed by people that are also very wealthy and called Congress, right?
Yeah, we have to have a functional Congress.
Most of the congressmen are millionaires.
Yeah.
And so you're asking them to tax themselves.
Yeah, Nancy Pelosi's got her own chat room. That's just an investment following of just her investments.
But that's really what has to happen if you want a redistribution of the wealth.
Mm-hmm.
I'd say the other thing is that the cycle of the markets also really helps the wealthy. So the boom and bust cycle, one, rich people can handle the boom and bust cycle.
Mm-hmm.
And two, they have enough capital to deploy when it does bust to buy up everything.
Yeah.
And we've been doing that cycle for quite a long time.
Yeah.
And the way that they're running the Fed and the way that we're running the global economies, it's happening more frequently.
Yes.
Which just means that wealth compounds faster for the wealthy,
Mm-hmm.
and it more frequently wipes out the underprivileged or the lower class people. Even that's why the middle class is disappearing too, by the way.
Oh, I
Because
mean, what the
they
fiscal,
can't keep up when you wipe them out once.
what the fiscal, what the CARES Act, started with the CARES Act, did to the United States small business owner is just
Yeah.
tragic. I mean, we're like big boxes and oligopolies and chain restaurants. And it's like watching the soul of the country get sucked away. It's just, but there's something economic about inequality as well. It
Mm-hmm.
presents a fundamental risk to the economy.
I think it does, because eventually people quit working, and I think we're seeing that now.
Right.
People start dropping out
Mm-hmm.
of the economy because they're not rewarded for being in it.
Right.
That's a concept and a problem in this country that I don't know that I have a solution for personally.
Mm-hmm.
I wish I did.
Well, it starts with education, which is that takes you back to a dysfunctional Congress.
The education, but I mean, we're at a point now, and I work for an educational institution, so I probably should be careful what I say, but we're at a point now where we're sending an awful lot of kids to school with an awful lot of debt. They're coming out with a lot of debt,
Mm-hmm.
and we're saying, go get that job. Well, a lot of those jobs aren't there anymore.
No.
And
no. I
to
mean,
me,
the pandemic has taught employers that between the pandemic and big data. I mean, if you're a big law firm, I mean, you're not going to graduate from undergrad and go become paralegal. Paralegal might be in Mumbai
Right.
with the entire law library on a chip.
Yeah. So I think it's very difficult for new kids, and I actually have my son's graduating college here in December.
Yeah.
And of course, he's like most young kids, and he wants to be a chief marketing officer of a gaming company, which scares me to death. I try talking about finance and not interested. But he really wants to be in branding, and branding for video games. But I told him, I'm like, listen, you can do branding in anything.
Right.
And the funny that you brought up your story about Dallas there, because I said the best place to do branding is in high end, by the way.
Yeah.
Because they actually have sales.
Yeah.
But yeah, it's a huge problem on how you keep young kids motivated, jobs created for them, and keep this economy going.
Yeah, and it's astounding that you read the report about Dennis McGill from Zelman and Associates. I mean, if his math is right, we're going to go from 25% of adults living with their parents in 2020 to 29% in 2030.
I think he's right.
Going the wrong way.
I think he's right just because the opportunity's right.
Mm-hmm.
The opportunities are going to be tough, or you're going to have 6 kids living in an apartment, right?
Well, I mean, it's
Where they're all sharing the
difficult to
cost.
convey to this younger generation that undergraduate degrees are commodities.
Mm-hmm.
They've been commoditized.
They have.
They're kind of meaningless. I mean, you can't stop at your BBA. You have to get something else when it comes to education
Mm-hmm.
to differentiate yourself in the marketplace that's just effectively shrinking.
Yeah.
And we see that in the labor force participation rate. To your point, every single time there's a boom and a bust, we have structural damage
To the
inflicted to
participation
the participation rate. It's just, it's terrible.
Yeah, I don't know what the answer for that one is. You're going to have to figure out how to create more jobs. I mean, one of the things I liked about, I read this story about Germany and their educational system that I found fascinating. It's something we don't do in this country, which is they would look at the quality of the student and kind of what they were best suited for.
Right.
And they would really steer a whole bunch of kids toward trades, right? Whether
Well, if you're
that's
suited to
whether
be
that's
an electrician
or whatever,
I
right?
mean, anybody who walks in your house, I mean, summers here in Texas, I mean, man, your HVAC guy he's killing it.
He's killing it. So, I think that's a thing that this country doesn't do well. There's a lot of opportunity in the trades, and we tend to tell everybody in this country that you need to go to school because you need to be a finance guy or a doctor or a lawyer or something really important.
Of course.
And we don't look up upon the tradespeople the way we should. Without them, we don't survive.
But they sure do have nice incomes.
They do. And I think that's probably something this country should really focus on.
No, and Germany retrains current workers. There's
Right.
like a public-private partnership between the government of Germany and and employers, to where if you know that the technology is going to change, you're going to reskill your worker while your worker's working.
Absolutely.
And I'm like, well, there's a nice thought.
Yeah. Whereas we say go in unemployment, good luck.
Exactly.
Right.
You're made redundant. There goes your industry. There goes what you're doing for a living. You've been innovated away. So so I'll ask a question about China by asking a question about Germany.
Okay.
If Germany had to choose, say in 2 or 3 years, if Germany had to choose between China and the United States, which country would Germany choose?
As far as a trading partner? Is that what you mean?
In the event that you go from currency war to trade war to hot war. Hypothetically. Because we've all got this on our radar right now. We talk about Taiwan. We talk about it very tangentially. We talk about Ukraine because no geopolitical event has affected the markets since we've been in the business.
Yeah, I think, frankly, if I'm Germany, it's probably not the United States. And I hate to say that because, I love this country, etc. But there's 1.3 billion people in China. If you're going to sell cars, and that's what Germany does best, I'm probably going to pick that market.
Well, they do more business with China than they do with the United States. It's period end, and it's a very recent it's a very recent flip.
Yeah.
But in direct investing, it's
the same thing. Like, would you rather partner with India than here? Probably. It's probably going to outpace, its population outpace China at the pace they're going.
Look, I think international.
They don't have any roads, but
I was going to say, I think international infrastructure in India is probably going to be a safe place to be in the next year. It's going to be a good place to hide if you can get to the politicians and actually get the ground. Government corruption has obviously been the biggest impediment to making India the next China.
Yeah.
But I think somebody will figure it out.
The impact China's had, I think, globally is just astounding. Like, we have some investments, and I won't name the private equity guy that does. He's pan-Asian, this private equity buyout shop that we have money with. And it's interesting because the returns are staggeringly good. Just amazing. And, I was talking to my private equity guy in my shop, and I'm like, how much of that is China? Because that's where he's killing. So we pulled up and went through line item by line item. Not one investment is in China.
Wow.
Right. So this is, I'm not going to say who it is, but it's a massive global player. It's like one of the biggest powerhouse firms in the world.
Yeah.
You got to ask yourself why.
Well, China's at a 30-year, China's growth rate's at a 30-year low from what we're being told. That's probably not true.
I don't, first of all, I have a hard time believing that. I'm sure we're being told that. But even with that said, there is massive investment opportunity available in China. Like, let's just talk about healthcare for a second. That is a huge area where you can make a killing. You can make a killing in technology in China, right? The scale. We had one manager build Burger Kings, of all things, in China. He built 275 Burger Kings. It was a 5x trade for us.
Gosh.
On Burger King. It's not even that good.
Right, no. I have one down the street in Dallas that just closed.
Right. So my point is, why would this manager, who is clearly a global manager that's phenomenal, not touch China?
Yeah.
Is it because the other opportunities are so great? Or is it because we're concerned about China? I think it's the latter. I think there's plenty of opportunities. They have people on the ground in China. I think there's plenty of opportunities in China. I think they're seeing the same thing that a lot of people are seeing, which is, what's going to happen in China, and how are they really going to treat America, and how is the conflict going to go?
Am I going to get my money out?
And we're talking about locking stuff up that could be 10-year lock, right? This isn't a public equity trade. It's you're buying a private company and then trying to build it. And this firm, who I consider to be one of the best, has said, no, we're not going to do that. And to me, that's like a canary in the coal mine that says, wow, maybe we should be paring back. For instance, at Tech, 5 years ago, we started doing private credit in China. We also have some venture cap there. We have a number of things there. But we've been talking about this last year. It's like, okay, now we have a track record of this private credit in China. How much better is it than developed market private credit? Like, are we getting paid to take that risk?
To take that risk.
And I'm not just saying currency risk. I'm talking geopolitical risk.
No, you're talking about nationalization.
Right? You're talking about nationalization.
Yeah,
absolutely.
basically.
There's a lot of risk here that we can't underwrite well. Like maybe for the CIA we could, but CIA doesn't call us and help us with that.
Exactly.
So, we sat there and looked at it, and you can go back and look at, there's 4 different managers in private credit that we have over there. Only one of them's really done better than our other managers that are, whether they're in Europe or the United States. The other 3 are just kind of in the middle of the road. So what are we doing? We're cutting ties with all of them.
Yeah.
All 4 of them. We're like, look, we're taking an awful lot of risk that we can't quantify well, and we're not really getting much for it. Let's just come back and have a place where we at least know the rule of law's on our side.
Right. The irony of China is that their doors are wide open for money to come in.
Right.
And yet the saber rattling is getting really loud.
Right. It's almost like having children. Money always goes out, it never comes back.
Gosh, that's so true. Especially the one daughter. Gosh.
But I think that's a big issue for everybody to think about in the institutional side is, how tied do you want to get to China and how much money you're willing to put over there? There's a lot of arguments to put more money, right? MSCI, they're a very low weight in the index, but they're slowly growing. A lot of people are going, hey, we should be GDP weighting this. They should be way higher.
Oh.
So think about that. If you GDP weight that thing,
gosh,
you're quadrupling your allocation. So, these dilemmas are being argued in public pension funds all over the country and endowments. We're choosing not to GDP weight. I think that's not the right way to think about it myself.
No.
I would say if they were a true, more of a democracy and open society, I probably would GDP weight it.
Sure. But we're learning quickly.
But they're not. And I think the opportunity for us to have conflict with them is growing rapidly. I think it's almost inevitable.
So you think that something will happen with Taiwan?
I think it's highly probable something can happen with Taiwan.
Well, we didn't do anything about Hong Kong, so what?
We also didn't do anything about Crimea, and we haven't talked about Russia.
Well,
but there's a whole other problem with Russia on the border right now, in a gas line that everybody's willing to look the other way because they need gas in Europe, right?
Well, yeah, Vladimir Putin's got a lot of power these days, and I've heard that freight is a train wreck in Russia as well, that they've got their own supply chain difficulties that they're dealing with on top of Vladimir Putin being a dictator effectively. But Russia and China share the largest contiguous land border in the world. They're right on top of each other.
I just think as
they would make interesting allies.
I think you very well could see that starting to happen. You can almost see kind of a new world order between, if they ever got together and actually could tolerate each other enough to work together. That's right. The real question, because Putin's his own guy and Xi Jinping he's his, they're their own people. But if they ever tie together well, you're talking about an awfully strong bloc that NATO's going to come take them on. As far as I know, all the power in NATO rests kind of singular with the United States almost. Right. I don't even think Germany has airplanes anymore. If they do, they're been bought.
Well, Germany has been building up its army. Germany's been building up its military in recent years. And this is kind of a very quiet development, because when you think about Russia and China and borders,
they need to build it up. And I think that was when Trump was in office, and I know he was not popular, but one of the things, in my opinion, that he did was, kind of saber rattle at NATO and say, hey, we're paying for everything, doing everything. That's great since World War II that we're able to do that. Yeah. It's now your time to start picking up and spending what you agreed to spend at a minimum.
Yep.
I think that was very smart, and I think we should continue that policy of pushing it.
Well, again, you're right, he was not popular, but there were generations of U.S. presidents who ignored what China was stealing from the United States.
Yep.
I mean, at least he, went off and sent off a tweet and got the country more aware
Right.
of the threat that China posed. And as soon as the country became aware of the threat that China posed, all of a sudden you start to see Xi Jinping exert his power and take down Jack Ma and go after the billionaires and, allow Evergrande to blow up. And it's Xi Jinping's march, the pace of his march is quickened.
Yeah.
And then you talk about Russia and all those natural resources. I mean, Russia's got more natural resources than anybody on the planet.
It's actually a phenomenal partnership if they ever do pull together, right? I mean, it's
Right,
it's
because
a
that's
good
the one
fit.
thing that China doesn't have is energy.
And they also both have a little bit of a disdain for the rest of the developed world. So
Yeah.
if you put those two together, that's kind of frightening. It also has a huge implication on business too, right? Like if you think just about markets and companies. So almost every company in the United States outsource to China. I mean, there's tons of manufacturing in China that's all for U.S. companies being produced there. In fact, I know a local guy. He sells T-shirts, cups, pins, the kind of marketing materials that business buys. That's his thing. And he was having a horrible time during COVID. Why? Because every single thing that he sells is made in China.
Yeah.
So it was during COVID, like everything got locked down. He couldn't sell anything.
I mean, we were here a few nights ago, and Christopher Cole said, look around this office. Probably 50% of everything in this office was made in China.
Right.
If you think about it, and I mean, if you think about the whole idea of nationalization, and if you look at the microcosm example of what happened in Venezuela, I mean, if you're a big U.S. company, you've got tremendous exposure risk, and yet it's so expensive to move your supply chain.
But they're going to have to.
Oh, I
So,
think
they're already
actually I
doing
think
it.
Mexico will benefit. I think I'm pointing to Mexico. I think Mexico is going to benefit from this.
I agree. I think Vietnam benefits. I think Mexico benefits.
Yeah, I mean,
et
and
cetera.
these are countries with better demographics too, right?
The other thing that I would think is a policy thing, because I mean, we touch on the fact that we're concerned about what's the opportunity set for younger kids right, in this new world that we're living in now.
Yeah.
And I think globalization has taken away a lot of opportunity for developed worlds.
Yeah.
Is there advantages? Absolutely. We can buy more stuff, right? But that's what it's about. It's about the rich having more stuff, right? At a cheaper price, nicer things, right?
In Silicon Valley, these massive companies, and there's no antitrust to speak of in the United States of America. I think that's patently apparent. But, Silicon Valley, the largest employers in the United States, employ fewer people based on the money they make. So they're not these massive employers.
They're not at all.
And yet they're the biggest companies in America.
Yeah, absolutely agree. But I'm thinking that if you could get the supply chain problem, so if that supply chain problem comes back here, like we're doing it with chips right now, the government's helping sponsor because
Sure,
it's
of course.
strategic. But if you just think of all the other things that are manufactured, we should be able to pull back some of that stuff into the United States, right? The United States has to be at a point where they're comfortable enough paying more money for items, right? So it's going to drive inflation.
Right.
But if you want to put young people to work, the rich got to be willing to pay more for stuff, right? Or you got to put some tariffs on stuff coming in to try to equalize the cost of that supply chain coming back.
Right. 24% of your average United States cars parts come from China.
Come from China.
24% is not a...
That's a strategic problem, risk anyway.
Yeah.
Right? I'm not saying I have the answer to it, but we've outsourced so much stuff through globalization that we need to bring some of it back so that we create our own economy and strengthen our own economy a little bit.
Well, and maybe this is the last thing you can speak to. How has COVID impacted this dynamic? How's the pandemic affected it?
As far as bringing assets back home, you mean? I'm sure it slowed it, right?
Where we're importing out our eyeballs,
Yeah,
but I think that's finally slowing down.
Yeah, I hope it starts slowing down and more people go back to work here. I think COVID's impacted broadly just like real estate markets and everything in a crazy fashion. It's like if you go to New York, right? New York's still a ghost town. Like I talk to my managers there and most of them aren't even working in the office.
And New York accounts for a gigantic proportion of office buildings in this country, and they've still got cranes up.
Yeah.
So it's
kind of frightening, right? Because people's demand for floor plate is going to rapidly change. It's going to impact real estate prices.
Mm-hmm.
I think you're much safer in residential, even though we talked about that
Yeah.
residential might be getting an overshot too.
Look, I mean, the pool of individuals who could be converted on paper with a mortgage from a renter to a home buyer, that pool that spiked during COVID has come completely back down to pre-pandemic levels. And we've got a demographic issue on our hand that few people are aware of.
Yeah, I absolutely agree with that.
And commercial real estate is also multifamily, like it has not been in any other cycle. I mean, tell me, share the story about the building that was sold and what the cap rate was.
Yes, this is obviously one of my favorite stories because in 25 years, I've never sold a building at this kind of cap rate.
So cap rate is, explain what a cap rate is if you don't mind.
It's like a price to earning ratio for a stock, only it's for profit.
So, but the lower it is, the more expensive.
Yeah,
okay.
It's inverse, right? So the lower it is, the better. So this was right down here in downtown Austin on Red River. So just a block off Congress. And we bought this several years ago because University of Texas was building out a medical center, and frankly this was within walking distance to it, and they hadn't really started building it at the time we bought it, but we knew it was coming. And we were like, if you just get in front of that, demand's going to be really high. You know, it's going to be leased. It's a rental. We'll do okay, right? We'll do all right. So we bought it, and then COVID hit, and actually we had a bunch of vacancies because kids moved back home, right?
Of course.
So this property kind of went like this, right? Came back up. And then recently we sold it at a 2.4 cap rate.
Gosh.
2.4.
Oh my gosh.
Which means we printed money. And
that's just insane.
And it is insane.
You can't even see 2.4%.
And like, I don't even understand the other side's argument, like why you're buying a fully leased building at that price, because there's no upside left unless you think inflation's just going to go crazy.
Unless you think rents are going to accelerate off of a 10% base.
And by the way, rents are continuing to increase, so you know maybe they are smarter, but I don't think long run it's a good trade for them.
Well, just put 2.4 in perspective, if you would. Like, what would it have been in 2007 at the peak, at the last peak of the commercial real estate market?
Oh, I would say it was probably more like a 4 cap rate.
Yes.
Right.
And that's the point.
If you sold that peak, it was probably more like a 4. So I mean, you're talking magnitudes better.
And we've got cranes up all over the country.
Yeah, God bless you.
I think this is an accident waiting to happen.
By the way, this is what makes a market. Like from my perspective, I think that's the best trade in the world because I sold to somebody else at that rate. That other side, he thinks he's got a great deal because he has some view that Austin's going to continue to grow forever, that inflation's going to continue to go, that rents are going to continue to go up. That's his view, right? It's a zero-sum game.
Yeah. Playing
the market.
Now, well, you have to have, every trade has to have 2 sides, right?
Yeah.
Regardless of your asset.
I've been at 25 years. I think I'm going to win this one. But,
I think it's a home run. I'm thinking it's a home run. So, so one last question. So, is there anything existential about working for Texas Tech, and yet you're here in the land of the burnt orange? So, I mean, do you ever feel conflicted during college football season?
Never.
Never
feel conflicted at all. I mean, I love University of Texas. I think they've spent $58 million changing coaches over the last 5 years.
I don't want to talk about it.
And they have the worst track record that they've had for 25 years. So God bless University of Texas.
It's like healthcare in America. The more we spend, the worse it gets.
No, I'm a Red Raider through and through. Guns up. I didn't go there, but I've adopted them. And
God love you. Good.
I love it when they play UT. Now this year was not fun for me because UT beat them.
Yep.
But I've been to several games when Texas Tech won, and couldn't be more happy. In fact, I surround myself with my UT friends when I go to them.
I love that, Tim. This Austin series is going to become a regular thing, so I'd love to. A year from now or so, let's check back with each other and see how the world has changed and see how those valuations have. Because I think a year from now we'll know some things.
I think they're absolutely going to change.
Thanks for all your time. I appreciate it.
I appreciate it. Thank you.
Well, I hope you enjoyed visiting with Tim Barrett. That was fabulous. We covered a lot of ground. I hope you've enjoyed this Austin series. We'll come back. If you've missed for any reason the interview that I did with Dr. Keith Brown, who was my inspiration, told me to go to Wall Street, and sits on the boards of the UT Endowment, sits on the board of the largest teacher's pension in Texas. Combine their insights. Go back and watch his, and then go back and watch Tim's over again, because I'm going to have to watch it twice. I learned so much. And you'll have a better appreciation for public pensions and for universities and for entities that really won't go away in our lifetimes, right? Universities don't go away. So the money has to be managed. So it's critical that as learners that we understand how they operate. And if for some reason you have not gone to quillintelligence.com, please visit the website. My research gives you just as much of an education as these series do. And for now, I will bid you farewell, and I appreciate you visiting with Down the Middle. This is Danielle DiMartino Booth. Thank you.